Hello everybody, it's Max Convexity here. Hope everyone's having a good holiday weekend. I've been sitting around and watching football all day and it's been very nice. I saw some fake news about QQQY and I wanted to talk about it real quick. It shouldn't really surprise us coming from CNBC or NBC, the number one purveyor of fake news in the universe.
Know how these things are going to perform. Well, the expression is picking up nickels in front of a steamroller. I mean,
no, that's not the expression. Let's review real quick. All right, so let's look at our option table here. You can see right here by the volume which option the fund sold for Monday. The 16,000 put. You cross over to where it says delta. This is a 60 delta. So it is not picking up nickels in front of a steamroller. What nickels in front of a steamroller means, this is one standard deviation down and this is two standard deviations down. These right here, the deltas on these options, these put options that are more than two standard deviations out of the money, that's way the heck down there. Those are picking up nickels. That's a nickel right there. That's why that's what nickel means. It means it's a 5 delta. There's also expression picking up pennies in front of a steamroller. That would mean selling these options down here. These 1 and 2 deltas. But no, selling the 65 delta, the 1 or 2 strikes in the money, is a big, fat, juicy target to aim for. You can see it right there. And here's a graph of the payoff. And this is what people miss a lot of times. Look what happens here. If this line is where the market is now, if the market goes nowhere, this trade makes 436,000. If the NDX goes up a quarter point, it makes 700,000. If the NDX goes down a quarter point, it makes 35,000. If the NDX goes up a half point, it makes 700,000. If the NDX goes down a half point, it loses 400,000. So that's still a net win of 300,000. It's asymmetric. It's the winning side is bigger than the losing side until you get under like 0.6% down move. Yeah, that happens every once in a while. But the thing that people miss, what makes this strategy so powerful, is this slightly in the money option is just a money maker. Look at this. Look, I'll reiterate this test. This is from 2011 to 2023. This is what would happen if you sold 165 delta put every day. That DT, that's 1. You win 71% of the time. Your average, you collect a ton of premium. You have a nice profit per trade. $150 per trade, and that's just on one contract. I based this up here on right now. I think there was 102 I think it was 102 contracts that it said that you could tell by the option table were open interest. So I'm pretty sure that the fund, the QQQY fund, sold this 16,000 for Monday. I looked on the website and it didn't have anything yet, but I bet you this is it. And I bet you they have around 100 or so of them. The other day they had 118. But anyway, you can just see this is just a huge, big, easy target to hit. More times than not, all markets go nowhere. Look at this. These dots represent daily closes. And you can see because the markets generally drift up, there's more in this area right here. But you don't get in trouble until you're under 0.6%, which means until you're under this area. Anything in the middle and anything up here, big winner. And that's where that 2 out of 3 statistic comes from. And that's why these strategies are so profitable, and that's why I'm so excited about this QQQY strategy, because they do this every day. So yes, it's a smaller amount, but they do it more times a month. I'm very excited about it. All right, on to the next fake news. And this one,
lag behind by around, seen a significant downtrend and a significant.
This Person's a lovely person, has a great channel.
Uptrend, so we can get a pretty good idea of how this ETF will react to market trends. When you look at the fund's overall performance since inception, with dividend distribution, the fund has managed to return a little over 2.2%. If you compare that side by side with JEPQ, which is a covered call ETF on the NASDAQ 100, you see that it does lag behind by around 1%, 1/5 of QQQY. Now, when you look at the fund's price return excluding its dividend yield, you see a very troubling case of NAV depletion. Within less than 3 months, the fund has already lost almost 10% of its net asset value. That is a very rapid pace. And it is all because of the dividend yield that the fund is promising to its investors. The 67% dividend yield that the fund promises translates to around a 5% monthly dividend yield, and most regular...
Okay, the fund doesn't promise anything. The fund promises that the dividend will go up and go down. The same people manage TSLY. This fund is too young. It's only been around a couple of months. But let's look at TSLY that's been around a little longer. All right, TSLY. So I guess she's saying they promise a 5% dividend or whatever. I mean, yeah, they want to pay that. That's what their models say they can pay sometimes. So they started off with basically $1 the first month on TSLY. Then it went down to 90 cents, went down, still 90 cents, then 82. Then it dropped to 44 cents from 82. So it's half or less than half from where it started. What happened to the promise? Well, if you look back at April, it was a bad month for Tesla, a bear market for Tesla. So the fund probably lost money on their synthetic, even though they made money on their covered call portion. Anyway, it doesn't matter, but they couldn't afford as big of a dividend that month. That's why they gave you a smaller one. So no, they don't promise it to you. They aren't locked into any particular one. And it can go the other direction too. 2 months later, the dividend was back to $1.06. Then 2 months after that, it was back down in the 50 cents range again. So no, that's the first problem. It's not a promise.
Their investments barely give that in a year. That means that the fund has to generate around 5% in income through option premiums in order to facilitate this dividend yield. But that is a very hard thing to do. And yes, maybe the fund managers will be able to achieve this at some point during the year, but it is not something that is sustainable. But
they're doing it right now.
because they are promising this insane yield, if they don't reach their target goal, majority of the distribution now has to come through return of capital. So when you look at the fund's net asset value on the 2 days where the fund distributed its dividend yield, its price on average fell by 4%. And if you multiply that over the course of a year, the fund's net asset value could drop by 50%.
All right, math doesn't work that way. Do they teach math in school anymore? You have to deal with the decreasing balance. I mean, if the bank figured out your mortgage that way, you'd be pissed. That's like saying that if I lost 50% 2 years in a row, I'd have 0% left. No, you'd still have 25% left. Let's review the math here. All right, I don't even know where to start. Yeah, you lose 48% if it's just a straight 4%, but that doesn't factor in the decreasing balance. It's actually 39%. So that makes a difference. But yes, if we get into a bad bear market, I could see the net asset value going down 39%. But also, guess what else happens in bear markets? Volatility spikes, so the amount they're able to earn from the option selling program will go up, and it'll partially offset it. That's what's the great thing about this strategy. It's self hedging to some degree. Let's listen a little bit more.
That is an insane rate of loss. And on top of that, the dividend yield will fluctuate and will fall significantly. First of all...
Okay, well now she has it right. The dividend rate will fluctuate. And it could fall significantly. She can't tell the future, so I don't know about saying it will fall significantly, but sure, it could fall. All right, I'm with you now.
They will have less cash available for cash settlement, and therefore they won't be able to sell as many put options to generate income. And over time, the dividend yield will also drop accordingly. So there's a very high chance that the dividend yield of this type of fund will not stay at 67%. Within just 1 year, it might drop to 50% or even 40%. Now, when you add in the fact that the net asset value of this fund is dropping by 50%, you will have a disastrous outcome.
All right, that's another logical flaw there, and it's fine. People that don't understand options wouldn't understand this. But no, as the amount that they're able to capture goes down, the reason that's going to happen is because volatility is going to get compressed. If we go into a multi-year bull market like that happened, from the end of 2018 to March of 2020, or from 2017 to 2018. I mean, when these multi-year bull markets where you don't even hardly get a 2% pullback, yeah, volatility gets super compressed, and I wouldn't be surprised if it goes down to where they can only pay 20%, half of what they're paying, 25, 30%. Yeah, that could easily happen. If that does happen, though, the NAV is not going to be shrinking at the same time, because that's going to happen as a result of a bull market. And as I've talked about many times, they'll be able to capture a portion of the upside too, so the fund will be drifting up. It will be lagging way behind, and people that just have the QQQs will be saying they're doing better and thinking they're doing better, but it's all about how you want your income. If you want it now or later. If you want it now, a portion of it now is income, or if you want to let it ride and till later. And that's kind of a you do you situation, in my opinion.
The whole goal with high dividend income ETFs is to find a yield on cost chart that is relatively stable, or in the best case scenario, trending downwards. And that is all for this one. If you haven't yet, make sure you subscribe to my channel and hit that thumbs up button for the YouTube algorithm. Thank you guys so much for watching, and I will see you in my next one.
She makes some nice points, and there's good graphics in the video, and she has a really nice channel. I'm not dogging on her too bad. I just want to take issue with one or 2 points that she made. But yes, the main thing is, yes, the net asset value drops by $1 about every time they pay a dividend. And that would be a problem if they were paying the dividend and they weren't making the dollar. They're paying the dividend out of trading activities. The QQY dividend is not Santa Claus, and we aren't 4-year-old kids. We understand how it works. There's YouTubers that track it every day. Look at Retire on Dividends. A lot of people probably follow him, but if you don't, you need to. He breaks it down every day to the penny how much QQQY made that day. If they're trying to short us on the dividend, Retire on Dividends or me will notice it, because we track the option activity every day. If I start seeing the option activity that they aren't making any money, but they're still paying a huge dividend, I'm going to come on the channel and talk about it. That would be a bad thing. It would be a terrible thing. The other thing I don't like about JEPQ, like I say, it's fine if you can afford it. JP Morgan, great company. But they used exchange-linked notes to get exposure to their short calls, as opposed to the public market like Jay and Defiance uses. We have no idea how much they pay. We have no idea what profits are built in for them, fees. We just have no idea, and that's the way it works. You aren't supposed to know. But I can guarantee you that JP Morgan could pay more than 12%. They're earning more than that, and they're keeping it for themselves. What do you want to bet that's the reason CNBC was kind of dogging on it at the first of my video? I bet you anything that JP Morgan's a bigger advertiser than Defiance. Those guys on options action probably go to Colorado in the wintertime with Jamie Dimon and some of the guys from JP Morgan. They're friends, and that's fine. But I would buy QQQY with my money, not JEPQ. But it's up to you guys. But I think whenever daily options came out, Jay sat around and was looking at JEPQ and thinking, oh my gosh, I can hold my beer. I'm going to use daily options, and we're going to pay 5 times what these guys pay. It's a great thing. Look at the name of the company, Defiance. To me, that means decentralized finance. Is bringing in the decentralized finance portion of it, power to the people, but it's also bringing in Defiant, we're defiant. We're tired. The little guy's tired of being ripped off for so long. That's my interpretation of it. Let me know if you guys have one. You know, old Max Convexity used to work in wealth management back in the 90s, and I'm sure a lot of stuff has changed in 25 years. But something that hasn't changed is whenever there's any kind of structure that the public doesn't understand, like an exchange-linked note. Back in the day, it used to be bond funds and mutual funds. There was so much juice built into those for the salesman and for the people at the company that it was hard for regular people to make money. That's when I saw QQQY paid, this insane rate. And that's why I started looking into it. And then when I found out they did options and I do options, it was a natural. So anyway, this has been a great video. I hope everyone enjoyed it. I enjoyed talking about this. I'm trying to get this little channel started. If you don't mind, give me a like. Or if I could do something better, leave me a comment and I'll try to do it better next time. I hope everyone has a great what's left of the weekend. Thank you very much.